All right, guys, welcome to day 9 of the 30-day series. This video is arguably going to be one of the more important videos of this series. This is going to talk about time frame alignment and why it matters. Okay, this is a very, very important topic. I get asked questions about this all the time, so let's cover it. So on the chart, you guys are going to see the MMXM framework and how to align a PD array to a certain time frame, right? Obviously, just because there is a fair value gap or an order block or a breaker block, like we discussed from the last video, does not mean that you just randomly get an entry. There has to be a buy model that forms on a specific time frame for each PD array. Now, if you guys look at this list, it'll run you through exactly which time frame PD array lines up with which time frame MMXM. So we'll start off on the monthly. Monthly PD array lines up with a daily MMXM. Essentially, this just means if you have a monthly fair value gap, we want to see the buy model form on a daily time frame. Okay. Obviously, this is not really going to apply to the day traders. Weekly fair value gap lines up with a 4-hour buy or sell model. Daily PD array lines up with 1 hour, 4 hour to 15, 1 hour to 5, and 15-minute to 1. Okay. These last three are going to be the more important ones that you want to focus on. Okay. The 1 hour and the 15-minute, occasionally the 4 hour, are going to be the ones that you're going to use in your day-to-day trading. Okay. So before we get too off topic, let's just get straight into an example. Take a screenshot of this, save this video, do whatever you need to do. There you go. So we have a 1 hour fair value gap here. This is obviously going to line up with a 5-minute buy model. Now, normally what people do is they'll see a fair value gap. They'll be like, oh yeah, this fair value gap looks good. They long the fair value gap with a stop loss below and then, target whatever they need to target. Sometimes it works, other times it does not. Okay. Now, the only thing here is you have a lot of risk. So let's compare this. We have 218 points of risk on the table. That's 1% on the NASDAQ, 872 ticks. It's a lot of risk that you'd be putting on if you just took this trade anticipating this to bounce, right? If there's no actual entry trigger here, then you are just trading hoping that it's going to bounce off of this fair value gap. You're not entirely sure, right? Even if you are sure, it's a good amount of risk to be putting on to a trade. 218 points. Now, let me show you guys how you can risk way, way less using proper entry models, okay? So this is what a normal entry would look like. Now let's drop into an actual aligned time frame right here. It would be the 5-minute, okay? Now, I will rewind this all the way back here, and let's watch when it first pulls into this fair value gap, right? Now, how do you avoid like getting faked out, whatever the case might be? How do you avoid that? It's by using a proper buy model. Now, for me, my entry model for any market maker model is going to be the flow model. That is a change in state of delivery, right? Just a very condensed version of that would be a change in state of delivery. For other people, it might be an inverse fair value gap, right? Whatever the case might be. I usually look at change in state of delivery. So for me to get an entry, I am not going to just simply enter at this fair value gap and then just, put a random stop loss, let's just say right there, and then target the highs, right? Because this is what tends to happen almost all of the time, right? That's what's going to happen to you. So what I like to look for personally is if I enter a trade, I want to see a change in state of delivery, right? Change in state of delivery, meaning we close above the manipulation leg, right? So this is the leg that made the low, right? This leg right here from this down close candle to this last down close candle made the low. This is the manipulation leg. So once we close above this, right, we get a change in state of delivery from bearish to bullish, right? Inverse fair value gaps work the same way. It's just an advanced change in state of delivery where you have a bearish fair value gap. We inverse through it, and that's showing you delivery switching from bearish to bullish, right? That's all that's happening. So what happens is this trade never actually gets triggered. And me being on that aligned time frame and watching for an actual entry trigger saves me a big loss here, right? What if you sized into that trade? It saves me a loss in general. So you wait for an actual setup to trigger, whether it be inversion fair value gap, whether it be change in state of delivery, whatever it might be. See, now what is happening here? We're finally starting to see some sort of a potential change in state happening. What happened was everybody that went long over here has now been stopped out, right? They got stopped out. And now that they've been stopped out, market is going to continue higher in this buy model, targeting the external range high right there, right? So first we get a inverse fair value gap right here. So we inverse the gap, and then we get shortly after, actually I think it takes quite some time. It chopped around for really long in this example, but we get a change in state of delivery here finally right there. Now this is a trade that I actually took live. So entry there, and I had a stop loss around these lows. I believe my stop loss was actually right here, and all I did was just target that high. This gave me a 4.4R, right? Now, compare this to the initial trade that we would have taken on that hourly time frame, right? 218 points as opposed to 30 points. Okay. You still catch a good chunk of the move. It's not like you're missing out on the move at all whatsoever, right? The move is just now starting, okay? So you're still catching the move, right? And what this is allowing you to do is, instead of just entering on a hunch, you're entering off of multiple confluences. So this is a trade that you can now size into, as opposed to thinking, okay, maybe it bounces off of this fair value gap. Let me enter, one mini here and keep a 200-point stop loss, and then I will keep my TP at the highs, right? Even if that trade works out, you risked a good amount. You're trading off of a hunch. There's no confluence. Nothing's really there for you to get an entry off of. This, on the contrary, you have an actual entry model, right? So once you see this happen over and over and over again, guess what? You don't need to take that large trade with the large stop loss anymore. This is now something you could size into. So I can make more money on this trade, even though it's such a small trade. This is happening on a 5-minute time frame. Even though it's a small trade, right? It's not the entire move from all the way to the fair value gap, all the way, to the external range high. It's not that big of a move, but we are still seeing a good chunk of the move here still, right? And what happens shortly after? We go and we take the TP right there, right? So there's 4.4R complete. Now let's take a look at this example right here. We have a 15-minute fair value gap. So the aligned time frame here is going to be a 1 minute, right? Now, again, normally, how would you want to frame this, right? You probably would want to just, short the 15-minute gap like this. Stop loss, let's just say, directly above the gap, and then, target whatever. Again, this is giving you a lot of risk, specifically 106 points of risk on this trade here. So how do you eliminate that risk? How do you stop trading off of just a hunch and you enter an actual sell model here, right? Again, you want to go down to the aligned time frame. So let's go down to the 1 minute and let's see if we can find where we get a sell model. Two things that I would be looking for here, either the change in state or an inverse fair value gap. Those are the ways that I like using for the sell models, okay? So right now, you guys can see we have gotten none of those. None of those has happened here. We have not gotten an inversion gap, and we have not gotten a change in state of delivery. This is a gap. We did not inverse it, right? That's pretty much the only one there. So let's keep going. And right there, what happens? We get a change in state of delivery. So we take this leg up, and the bottom of this leg becomes the change in state of delivery, right? There's your change in state. Now, either you enter on the closure, right, this candle right here, or we wait for a retest. We can wait for a retest here just because we're in replay. I know this thing comes back. So again, we want to enter on the retest right there. Stop loss at, one of these highs, either the high that creates the SMT, or let's just say a swing high of some sort. This right here is a propulsion block, so I will use that as a stop loss and then just target this low or that low. Now look at your risk to reward here compared to the other trade that I showed you guys off the 15-minute. So we went from 106 points of risk to 11 points of risk here. Even if we risk the high, right? Even if we risk the high, 23 points of risk. Okay. So let's watch and see if we get tagged in. There you go. We get tagged into the trade right there. And let's see what happens from here. Right. Again, it's not like you're missing out on any of the move. You're catching the move, right? You're catching the move. You caught the entire move. But we added confluences, right, that tell you that a market maker sell model is starting. You're not just trading off of a random hunch. You're trading off of real confluences that are happening in the market, real price signatures that are taking place that tell you that we are starting a sell model and it's okay for you to get an entry here, right? So that's your 4R, or if you took the stop at that high that I initially had, that's 8.5R fully complete right there. That is example number 2. Now for this last example, I'm going to showcase the 4-hour to 15-minute, right? This is a higher time frame. These trades don't happen as much, but when they do, they work out really, really well. Again, another trade that I took. All the examples that I've shown you guys here are live trades that I have taken in front of people in my Discord, okay? So this trade right here, we have a 4-hour fair value gap there, and then we have another 4-hour fair value gap lower. Now, if you don't have an actual entry model, or if you're not using some sort of confluence to enter this trade, how are you going to frame this, right? I'll tell you how I would frame this. No bias, like nothing. This is how I would really frame this if I was to take this trade. First, I would take a trade like this, where I have a stop loss, but then you have to think my stop loss is the start of another fair value gap, right? So how, do I really want to get stopped out and then have this thing go? No, I would probably want to stop out like right there, right? And then I would aim for at least a 2R so I can make that, trade worth it. And this stop loss is a whopping 471 points. Now, is that a trade that you really want to take? That's 2.5% on the NASDAQ. No, probably not a trade you want to take, right? So let's just say we risk the first gap. That is 175 points. A decent amount of risk that we're putting on, okay? And no confluence, right? It's a different story if we're putting on that amount of risk and there is an actual confluence there that supports your theory of us going to the upside, right? But in this case, there's nothing. In fact, a lot of people would look at this candle and think, okay, this thing is probably going to continue lower, right? So, and then the last thing is, how do you know which gap it's going to bounce from, right? You don't. You have no idea. Trading on a hunch. So this is where your confluences come in. So the aligned time frame for a 4-hour is a 15-minute. So we're going to drop down into a 15-minute, and we're looking for the same things: inversion or change in stated delivery, which we get right here. So what happens right here? Get rid of the lower gap. We get a 15-minute inversion fair value gap, right? Now, this is obviously starting to showcase signs of bullish delivery just based off of that alone by itself, right? Nothing else. Most people are going to be looking at this and saying, okay, obviously this is the 4-hour candle already developed, but most people are looking at this and thinking, okay, well, we make this whole move lower. They're probably looking to short this somewhere, right? But you can look at this from a market maker model perspective and think, okay, we push down into a higher time frame fair value gap, and on the aligned time frame, we're getting signs of a market maker buy model taking place. So there's no reason for you to be shorting this. We get our fair value gap inverted right there, and then this candle gets the change in stated delivery, right? So this is the one that I would personally take an entry on. Again, a trade that I personally took live. Okay, so you get the entry right there. And in this case, I had my stop loss off of a 1-minute SMT that was created. I believe it was right here at these lows. Okay. And then all I did was target, either you can target this high, which is going to give you 2.42, or you can target all those highs. Let's just say you went off of this. Let's see how this goes. I'm going to go over to a 15-minute to watch the trade play out. That's where we got the trade from, right? There you go. There's your first target getting hit, right? And if you want, you can extend this even further. I have no idea if this goes, but let's watch. Oh, there you go. Okay, so there's 5R fully complete to that external high, okay? And that is the final example, and why time frame alignment is one of the most important concepts when it comes to market maker models.